When underwriting a commercial property versus a residential property, lenders have a few more items that they need to take into consideration. And so we just need to talk about those differences here. One item that a lender would consider on a commercial property is a market study and an appraisal. And again, an appraisal would happen with a residential property, but the process is a little bit different for commercial. So with a commercial property, that appraisal is part of a broader market study because now the lender is concerned about the income potential for that property. And so the lender wants to have a firm understanding of the market, the current market conditions, and the potential for changes in the income stream related to that property. Another issue is the borrower's financials. The borrower would need to provide loan security in the form of personal liability on the note. So this means that the borrower would need to provide a set of personal financial statements. And if it's a corporation, then they would need corporate financial statements. And so this is additional information that the lender would evaluate in order to determine that borrower's ability to pay, particularly in the case where the income from that income producing property would not be sufficient to cover the note. At this point, the lender would determine whether to include a non-recourse clause in that note. And so this is a clause that would release the borrower from personal liability and make that property the sole source of security for the loan. So again, this is something that's very different for a commercial property and would not be applicable to a residential property where there would be no income available to be used to cover the note. So from the borrower's standpoint, this means that if you do have that non-recourse clause or provision in the note, then the borrower can really look at that as a put option. So you think about puts in terms of derivatives, and a put means that I have the right but not the obligation to put that asset on someone else. And so the non-recourse clause gives the borrower the right to give that property to the lender because there is no recourse if they can't pay. Another issue in underwriting commercial property is the loan to value ratio. So of course, the loan to value ratio is a concern in residential underwriting, but in commercial underwriting, most lenders require a lower loan to value ratio than maybe we might see with residential. So most lenders require that the LTV should not exceed 75 to 80% of the value of the property. So with residential, oftentimes we'll see those LTV ratios a little bit higher. And then lastly, the debt coverage ratio measures the extent that the net operating income, or NOI, from the property is expected to exceed the mortgage payments. So we could calculate the maximum debt service as the NOI divided by the desired debt coverage ratio. So for example, let's say we're trying to answer the question, how high can the loan to value ratio be in order to reduce the loan to value ratio to 1.2? So basically how high can the debt service be for a 1.2 LTV ratio? That's not what I meant. A 1.2 debt coverage ratio. So using our formula then, if we've got net operating income projected at $7,000 per year, then $7,000 is our NOI divided by the 1.2 desired debt coverage ratio would give us a maximum debt service of $5,833.33. And so that is what could be expended on debt service to maintain a debt coverage ratio of 1.2. So now, based on that, we could back into a loan amount if, let's say, we had a 6% interest-only loan. You take that $5,833.33, divide it by 6%, and you've got a loan amount of $97,222.17.